Another one that is, I think, probably one of the most interesting is the Kospi in South Korea. And so if you look at the Kospi, actually, even though you see this 19-year period and then 2 years and 8 years, but if you take the entire period from 1989 to 2019, which is 30 years, basically what has happened in 30 years, the Kospi has gone from 1,000 to 2,000. So over a 30-year period, it's about a little over 2% a year. And if you think of Korea going back to 89, I mean, this is before the rise of Samsung and before the rise of Hyundai and before really the rise of South Korea as we know it today. So incredible growth, huge economic growth, and nothing in terms of equity return. I have one investment in Korea, but probably one of the most fertile hunting grounds. Of course, the impediments are the language is an impediment, culture is an impediment, and such. But plenty of stuff trading at 3 times earnings and that sort of thing. And so if you want to go fishing where the fish are, I think this is where the fish are. And with equity markets, we usually cannot tell for the most part where we are unless we get to extremes. When we get to extremes, then it's obvious. Like I think you can look at Japan and you can tell it's a cheap market. You can look at Korea and you can tell it's a cheap market. The fact that Korea is cheap, all that means to me is, hey, maybe spend more time looking at Korean companies, but doesn't mean that I can obviously make an investment. If we can find businesses that we can understand within circle of competence, they're cheap and so on, then I think can look at them. One of the biggest lessons, the most important trait to be a good investor is patience and extreme patience, which is difficult for humans. So the interesting thing about equity markets is, if we look at our phones or look at screens, we've got flashing lights, red and green, and things are changing by the second and such. Real change in businesses takes years and sometimes decades. And changes in market prices of equities happens in seconds. And so the two are, in many ways, disconnected from each other. And so I think Fidelity, the big brokerage house in the US, in the mutual fund shop, they had done a study. So they have a lot of clients who open accounts with them and then manage those accounts themselves. They buy and sell stocks themselves. So they studied all these accounts that people were running on their own to try to figure out which of their clients were really good investors. And so they found that there were a set of accounts which was sitting like in the top 10% performance of all the accounts. And the overwhelming number of the people who owned those accounts, they later found fell into one of 2 categories. Either they were dead, which means that they had the account and then they were no longer, there was no pulse, okay? And people forgot that this account was there and it just kept going, doing really well. Or they had forgotten they had the account. Okay, so the 2 best performing criteria was either you were dead or you'd forgotten. Okay, and so generally speaking, activity in investing is likely to hurt you more than help you. 찰리멍거 mentions that he's been reading Barron's for 50 years. It's a weekly magazine in the US. And in 2003, after 50 years of reading Barron's, he got a stock tip from Barron's. So each issue of Barron's has about probably 10 stock tips. And so you're getting about 50 issues a year. Over 50 years is 2,500 issues, 25,000 stock tips. Okay, so he goes through all the 25,000 stock tips, picks one. Okay, after 50 years, which was a company called Tenneco, auto parts and service centers and such. And in 3 years, so he puts $10 million into Tenneco in 2003. By 2006, it's worth $80 million. 8x in 3 years. And then he gives that 80 million to, for the first time in his life, an outside manager, Li Lu, investing in Chinese equities. And the 80 million is now, I think, sitting, I'm estimating, at around 800 million. So, the willingness to wait for a really fat pitch is a very, very important trait.
Stocks you own are going down in value. It's our ticker value is going down, market prices. But you inherently think the company is intrinsically valued far above the market price. What tools help you as an investor to stay the course and to not allow markets guide you?
I'll tell you a little story. My dad was an entrepreneur who went bankrupt many times over his career. Usually his biggest flaw was too much leverage, and then things would blow up, but then he would find some new idea and get going again. And my parents were very bad financial planners, so there really wasn't any savings or anything. So if business went down means we had difficulty making rent and groceries and so on. So I think I was like 11 or 12 years old, and my father had just gone bankrupt, and the business had gone under. And every Sunday there was this guy in orange robes with all these marks on his forehead coming to our house, and he was an astrologer. And my father was consulting him about the future. What's the future going to be? And my dad was a very rational engineer, So I went to my dad and said, you have to know that everything this guy is telling you is total nonsense. You have to know that. So my dad says to me that I'm at the bottom of a well, and I need a rope to come out of the bottom of the well. And when I pay this guy to tell me about the future, he knows that he's not coming back next week unless the forecast is really rosy. Okay, so it has to be an exuberant future. And he also knows that the more rosy it is, the slightly higher he might get paid. So every week when I call him, he paints this picture: you're going to start another business, it's going to do really well, blah, 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 and I'm gradually coming out of the well, right? So that's how my dad explained this to me, right? So let's say like the financial crisis, when I was down 70%, for example. I thought about my dad, and I thought about that astrologer, and I didn't have his email address. That's who I needed then, Tell me what the performance is going to be, and I'll pay you, and I'll pay you more if it's going to be more, And but I couldn't find his email address. So I had to come up with my own rope to come out of the well. And so what I did was, one of my rules of investing is thou shalt not use Excel. But I said, let's violate that rule to come out of the well, because coming out of the well is more important than Excel. So I created an Excel spreadsheet which had my portfolio with the current prices. And then I put down the price at the end of 2009 or end of 2010, 2011. And all those future prices were much higher than the current price. And then I looked at the value of the portfolio at those times. Those numbers looked really good. And that was the rope. And so we all need ropes to come out of deep wells. And I don't have the guy's email address. So you need to find your own rope, in effect. We buy things that are cheap. We understand the business. That's all fine. They get cheaper. And they can be cheaper because you made a mistake, or they can be cheaper because it makes no sense. The markets are mispricing it even more. And until we figure it out, we need some rope to, it would be a mistake to sell things just because they become cheaper. I think you can sell things if they're cheaper if you're convinced that the current value of the business is below where it's currently trading. But if you're not convinced of that, you're better off being like the Fidelity dead clients and doing nothing. So everyone needs a rope.